this is a mess, and this doesn't end well. And where we were in 2008 was basically a warm-up or precursor to where the next one's going to go. And I'm not so sure that this next one, the central banks par excellence across the globe, are going to be able to rescue the system.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnston with your SD Weekly Metals and Markets Wrap. And with us today, our guest David Morgan, and also joining us is Eric Dubin. Eric and Dave, thank you so much for joining us today.
Thank you, Elijah.
It's great to be here.
All right, now let's first discuss the precious metal markets. This week, gold and silver are both down. David, what is your perspective on what's been occurring in the markets this week?
Well, we've had gold and silver basically drop off rather substantially here in the last several trading sessions. We broke through the $1,300 level, and then shortly thereafter we got to about $1,350. There was a lot of articles talking about gold hitting 11 or 12-month high. And I said that, one, before it happened, I thought that gold would go through the $1,300 level because it was a third attempt. And that's pretty standard if you study the futures market the way that I do. And then I also said at the top that there's a little bit too much, it's overbought, too much positive sentiment. Everyone's sure it's going to 14 or 14.50. It'll probably retest the $1,300 level, which it's done. And that's also pretty typical of the market, manipulated or not. It's what markets do. So that's where we are now. Longer term, since we didn't get a big bounce yet off of that level, I am leaning toward it being weaker for a while. And if it stays under that $1,300 level and doesn't retest it to the upside here in the next, let's say, couple of weeks or so, 10, 12 trading sessions, that data would give me the idea that we might get even weaker in the end of the year. I don't like saying that. That's not what I want, but I try to stay objective, even as tied to the metals as I am. I still try to analyze it from an objective point of view.
And what is your perspective on what is driving the price, Eric?
Well, the FOMC news and the rise in the dollar that came thereafter. The dollar was actually ready to do its own bounce because it had a long period of decline. That's really the primary catalyst. And then again, we also saw a lot of manipulation that was helping to push the gold over the edge as it declined, as is always the case. I agree with Dave's assessment as far as, the damage done and how that'll play out and how people will respond to that from a technical analysis informed way as well. I think that the stock market is far more precarious at this stage, and that alternative assets, gold primarily, will catch more of a bid later on this year, just because of the instability on a domestic political front, the geopolitical front, the wins that Trump can trumpet when it comes to his tax plan, and all of that is not going to change the fact that we have been living on borrowed time with this artificial economic stimulus that has created overvalued markets everywhere you look. And I don't think that the stock market is going to continue on its happy-go-lucky march to higher and higher and higher highs, even though that's what we have seen all year, and we're now this week in new highs, the S&P 500. But at some point, that air is going to start leaking out of the system, and when the Federal Reserve tries to start their taper or their quantitative tightening to the tune of $10 billion next month, and then escalating that to $30 billion, and then thereafter even more, per their pipe dreams, that's going to take a lot of liquidity out of the system. I mean, they make the argument that they were pumping up the system with QE, and QT, quantitative tightening, is going to pull liquidity out of the system, but they conveniently like to pretend that that's not going to have a negative impact, and it most certainly will. So, we have a lot of headwinds against the stock market and against the bond market, and tailwinds coming for precious metals. And at some point later this year, I believe that's going to continue to provide upward pressure for the markets and support them. So, yeah, we may very well see us dip down, like Dave said, but I think the underlying support for precious metals and the continued strong demand, particularly in Asia, remains. So it should be just a temporary pause in our ongoing bull market.
I'd like to add on to that a bit, Elijah. Just this FOMC, I mean, it's so much nonsense as far as I'm concerned. I mean, if you do the arithmetic, if they, take, their balance sheet starts to taper off at the rate that they announced to the public, it would take 23 years to taper off the $4 trillion plus that they have on their balance sheet. Think about that. I mean, are these people serious? Do they think that they're talking to like third graders? I mean, a sixth grader could do the arithmetic. So they're going to taper.
Assuming there's no blow-ups that they have to fix, and there's always blow-ups that they fix. That's the way the Fed works.
Exactly. So, I mean, yes, the market react to it, yes. Part of this is dollar bounce. It was technically due, and I want to make everything. I don't want anyone to think all I do is technical work, because I do far more on the fundamental side. But I studied technical analysis very diligently, and I found it had some merit, and some merit doesn't mean it's all knowing, all doing, could be everything. And my technical work these days is extremely simple, but I don't want to make this about me, but I've gotten rid of so many of the indicators, because you get too many, it's very confusing. I've simplified it a great deal over my years of what I do. So anyway, back to you guys. Thank you.
No, definitely. And Eric, what is your perspective? I mean, as David is talking about, it'll take, over 2 decades for the Fed actually to normalize its balance sheet. So how is this actually going? You're saying that it's going to have downward pressure on the stock market, but it's like for 20 years. I mean, how do you see that happening? It doesn't seem like normalizing the balance sheet is really, they're not going to be doing much. How is that going to have an impact on the stock market?
Well, the stock market has benefited by a lot of different drivers that came from cheap credit. So, for example, we've had over $1 trillion in corporations going out into the market, buying their own stock and retiring the shares, and that's helped, push the market up. You've had corporations being able to do a lot of leveraged purchases and investments and so forth that have come about only because there's been this zero interest rate or very low interest rate paradigm across the world. And it's not just the United States and the Fed. I mean, if you count up all the central bank activity, I mean, you can come up with numbers in a neighborhood of about $300 billion worth of liquidity that's flowing into the global capital markets on a monthly basis. So that kind of tide of money is just, it's unprecedented. There's nothing ever been like that in human history. So yeah, the Fed will ultimately not, frankly, have an immediate impact for a number of years, other than psychology and how that changes, because of the fact that the other central banks are, pedal to the metal and putting out tons and tons of liquidity all the same at the same time. The Federal Reserve will probably be able to pull off a couple of their $10 billion per month quantitative tightening efforts. It'll pull some liquidity out of the marketplace, but that's going to happen exactly at the same time that we've been at 100 plus months of this so-called economic recovery and long duration of asset prices being inflated by artificial means. And that's a recipe for disaster. I mean, markets don't go growing to the sky, and over time you end up having reversions to the mean, and that's exactly what's going to happen. That's a historically informed statement that's factual. I mean, markets are known to act that way, and there isn't a darn thing that the Fed can do anything about it. And they have 50-plus year track record of basically blowing things up by their incompetence. And they have never, ever done any kind of counter-cyclical policy effort that worked. Every single time, and certainly since we've gone off the gold standard in the financialization process of the U.S. economy and gone into hyperdrive, every time we have a crisis, markets blow up. They try to come in and fix them. They create tons of liquidity and sows the seeds of excesses thereafter. And we go through this cycle over and over and over again. And each crash gets bigger and bigger. And this last time, they basically refinancialized everything with a level of credit infusion bigger than anything in human history. And it's created these kind of subterranean bubbles that are like landmines waiting to blow. The Fed will taper at some point to the degree to which it will impact psychology, along with the confluence of something that happens within the economic/political front that'll bring the market down. I mean, 10% plus corrections are normal in stock markets, and we're going to have another one, and the next time the next one surfaces, the Fed is going to freak, and they're going to try to reflate the economy before asset prices crash, because so much of our economy is now floated on this artificial paradigm of inflated assets. And they'll never get through the entire quantitative tightening process either, as they have outlined, because of this fact. The markets at some point are going to have a very serious correction / full-on bear market. And the Fed's response to that is very predictable. They will try to reflate the markets thereafter. So this whole notion of the balance sheet reverting to what was sub $1 trillion, I believe it was in the neighborhood of about $800 billion prior to the launch of QE1. And that's just not going to happen.
Now, what is your perspective, David? I know last time we had you on for the SC Weekly Metals and Markets Wrap, you were saying that the stock market is topping. Is that still your view?
It is, but, I feel, everyone, well, I don't know if everyone, for myself, I'd like to be right most of the time. As a human being, I don't expect to be right 100% of the time. But, if you would have asked me last year, and I've said it last year, the September-October timeframe is a seasonality. It is worth paying attention to, and normally that's the hardest time for the stock market. I'm saying it again this year, and yes, it is overvalued by any metric. However, that doesn't necessarily mean that October is going to, have some type of October surprise and we get a decline in the stock market. It's past due, but that, again, doesn't mean it's going to happen. But, yeah, it's overvalued. I have no qualms saying that. Where I'm remiss to, make a hard statement is that, yes, it's going to happen, next month. When I really don't know. It's really tough, and I hate to use the, manipulation card all the time or whatever, but when there's these algorithms driving all these markets, I mean, it's really tough to, get a handle on some of these things. And the biggest manipulation of all, I said this in a speech in the January Vancouver show, which is one of my favorite gold, silver, resource shows, that if you manipulate the interest rates, that creates a manipulation of all markets, because all markets are based on the cost of capital and what that means and the signal that the cost of capital gives to all markets. So by definition, if you're controlling the credit market's interest rate, not letting the free market determine if it's high risk, low risk, or in between, you essentially have controlled everything. And that's where we've been, as Eric stated, for a very long time. It's coming back to the stock market. It's past due. Is it going to happen this year? I don't know. But I will say, putting my neck out there one more time, that if it doesn't happen in the fall, we don't get a fall in the fall, I do believe that we're not going to get through the first quarter 2018 without at least something like a 10%. And that's a minor correction, really. I mean, 20% is more likely, and even 30 is possible. But with the control mechanism in place as they have been, the problem with these software programs is once these analogs start seeing it's better to go short than long, the computer has no problem doing that. So it starts feeding itself on that direction as well. So it remains to be determined. I wish I had a better answer for you.
Now, I'd like to get your perspective, David, on the mining shares. What do you see happening in the mining sector this week?
What's very interesting is that the mining shares have done exceedingly well relative to this last drop in gold that we talked about at the beginning of the show. And normally that's a strong indication that we're going higher. So I'm actually pretty pleased with the way most of the major, top tier, mid tiers that we have in our model portfolio have held up. And of course, with the juniors, that's really tough to make a call because they're small cap companies. We do have a special situation company that's very got some very good news. This actually was the end of last month, the last day of last month, that a major Fortune 500 company has basically partnered up with this company, and so I'm pretty excited about that. But I'm happy that the miners are doing as well as they are, and they're still really undervalued toward everything else. So it is a value play if you're interested in that sector. And it's not just, gold and silver. I mean, there's stuff out there in the cobalt, lithium, vanadium world. The rare earth elements thing has kind of fallen by the wayside, although they're still very important. And, this energy metals seem to be the flavor du jour, where people are interested in, how do I invest in cobalt, lithium, that type of thing.
Eric, what is your perspective on the mining sector?
Well, the miners, they haven't been leading the sector down this month. They've been pretty much trading along with the pressure in gold, and I think the more longer-term money that miners tend to reflect in terms of, investor sentiment still is positioning for a longer-term bull market move, and recognizing just the basic divergence between relative value and the fact that the stock market and the bond market are highly valued vis-a-vis a sector that has been largely neglected for many years now. So, the overall health in the miners, I think, is pretty strong. I think that they're going to track where the bullion market's going to go. And I see every reason for bullion to continue to move higher, despite the fact that we'll have a lot of headwinds when it comes to either manipulation or, the market's dealing and trying to digest what is the perception of, quantitative tightening and rising interest rates and the possibility of the dollar rising as well. But all that factored in, combined with the bull market, underpinnings of our political and geopolitical turmoil, will keep gold where it is. I don't think that we're going to see much decline from this point forward. Maybe we'll get to 1250 or something like that as we move forward in the next couple of weeks. But miners should, in the very least, just track gold and not lead it down any further, because it really does look like there has been a significant shift in the overall psychology of the interest in precious metals. And even though we have declined a lot from earlier September highs, this doesn't look like some kind of major catastrophe. We have gone through many FOMC announcements and shifts in policy, and this last week and a half has been kind of similar to all of the other times that they've talked about raising interest rates / reducing the balance sheet. We've either seen one of two things happen. In the first two times when they raised interest rates, we actually saw gold go up. And on all other times, it's been a kind of 3 to 5 day period of healing after getting our heads beaten in. And that is kind of where we are right now. The dollar went down today, and gold is somewhat stabilized. I mean, we certainly can see a lot more downside as the weeks move forward, but it does not look like there's this massive carnage in response to a shift in policy. So I think the miners will perform very well, and they typically will do 3x or whatever gold does over the longer term.
Now, I know last time we had you both on, you were both saying that possibly gold could end the year around 1,400. David, is that still your view? I know you were saying that it seems like you're a little bit more cautious now and thinking that gold may end the year lower than that.
Yeah, I don't like to be wishy-washy, but the reason you subscribe to somebody like me that does a lot of fundamental work and tries picking value stocks, which we've been very successful doing, is timing, and it's really difficult. So as things change, I change. I don't control these markets. So right now, if gold had popped, went under 1,300, if it popped back and the volume was, above average, I'd say it's almost a cinch we'll see 1,400 by the end of the year. That's not what happened. We didn't have excessively large volume on the downside either. So I'm kind of neutral right now. Will it hit there? Don't know. I mean, a lot of this stuff, as Eric, and I don't want to speak for Eric, but, there's many things, and I used to say it on almost every interview. I mean, there's these black swans flying around out there, and you never know when one's going to crash into another one. And any one of those things could take these markets far higher almost overnight. Now, I'm not predicting that, but I have to make that caveat because it's true. And, oil's been looking firmer. The dollar had a technical bounce. But what has happened politically that's really been of substance to correct any of the problems that we have? And the banks are oblivious of what to do. They have no conception of doing anything more than what they've always done through all of recorded history, which is just to print till everyone gives up on the currency. And that's probably that is not only what is taking place. If you look at how much debt China has offed onto the marketplace, and the Fed's the buyer of last resort, and everyone wants out of the dollar. The only reason dollar is as high as it is right now is because it's one of the few places where you get a positive rate of return. If you want to go into the euro market, you're going to be getting a negative rate of return. So positive anything looks better than a negative something. So that's actually keeping more people as suckers into the dollar bandwagon than would be there otherwise. So this is a mess, and this doesn't end well. And where we were in 2008 was basically a warm-up or precursor to where the next one's going to go. And I'm not so sure that this next one, the central banks par excellence across the globe, are going to be able to rescue the system.
All right. Well, Eric Dubin and David Morgan, thank you so much for joining us today. I guess before we let you go, starting with Eric, are there any last thoughts you'd like to add?
No, I think we've covered pretty well what's going on, and we just live in an artificial world where central bankers are chugging in $300 billion worth of liquidity every month, and that truly is the most important dynamic in our markets, and that can't go on forever. So the importance of having insurance that's outside of the banking system, exposure to bullion, as well as some of mining share exposure is really important.
I have nothing to add. I think Eric and I always seem to have a good back and forth. He got me kind of, I mean, I sound, I don't want to take too much more of your time, but I mean, it's just so appalling that the average man in the street can't even get the concept of how bad it is. But, there was I've watched so many of the documentaries on the 2008 crisis, but I remember one was purportedly Geithner saying, the people on the street are showing like Lower Manhattan don't have any idea, and they don't. But everyone will learn after the collapse. Everyone will know about it then. We won't be such conspiracy theorists, numbskull, know-nothings once it happens. But, you can only call the signal out. You're not responsible for the ears that hear.
All right. Well, if people are interested in learning more, where can they find you, David?
morganreport.com, or our better website to pick up our free report on riches and resources is that website, richesinresources.com. 11-page report I just finished updating just a couple of weeks ago. It's free for everybody. It gives you some good insights into where we think the resource sector is going to be going over the next several years.
All right. Well, this has been your SD Weekly Metals and Markets Wrap with Elijah Johnson, Eric Dubin, and David Morgan.